Hi, I'm Eric Judy.
And I'm Dick Van Dyke. We want to talk about long-term care this week. It's continues to be a subject that we frequently get into with our clients. It's a big part of planning, and we hope we don't need to use long-term care,
Right.
but we never know.
Exactly. When we look at it, especially when we're working with folks that are considering annuities, a lot of the annuities we see actually have a long-term care component either as an additional rider or
Right.
a piece that's actually included as part of the standard with the
Right,
annuity.
right. Some type of a supplement
Yeah.
to long-term care need.
And I guess let me start with kind of the standard. We usually, for some annuities, we have call it the income doubler. You're already taking your income.
Right.
If you would have a long-term care piece come up, basically that was needed, you'll see a double in the income that's provided
The
to you.
guaranteed lifetime income, you're right, will actually double.
Okay, so is that a good replacement for long-term care insurance, or is
I look at that more as a supplement, and it depends. Everyone's situation is so unique and different that you have to look at. First of all, are you married? Will there be maybe a well spouse while one spouse is potentially in a long-term care situation? They're going to have more expenses in that situation because the well spouse has to go on and have their standard of living, and yet someone needs to be in long-term care, and that can be potentially very expensive. So it would depend on the amount of money that they had in the annuities, in the income rider, and how reliant they were on the income from that annuity for their regular living expenses.
yeah, so you have one spouse that's living at home basically,
Right.
and another one that's living in
Right.
a long-term care facility. So you're paying for both of those pieces simultaneously.
Right. Another one that we can talk about to kind of identify some of these annuities that help with long-term care is it's like a three for one. So in essence, just to use some numbers that are kind of easy to work with, if say folks you put $100,000 into this particular annuity, and you got into a long-term care situation where you needed to use this for long-term care, then that 100,000 would have essentially become 300,000, because when you set it up, that 100,000 would be used first for your long-term care, the money that you put in, the premium you initially put in, but then there would be an additional 200,000 that could be used towards the long-term care. Now, some of those, Eric, they have to be underwritten.
Okay. So you have to, in most of these standard just long-term care policies, you have to have underwriting with it. And so obviously, when
Now,
we
under-
have
Go ahead. Sorry.
just long-term care.
Right.
So those are all underwritten. That part,
Right.
they're going to basically medically underwrite you, and
Well, some of the annuities are very easy to be underwritten. Some of them have no underwriting,
Right.
which you know
right.
that.
And so the
Yeah.
difference there, in an annuity, typically there's virtually none for most of them.
Right.
If it's
Right.
that income doubler or those pieces.
Right.
Now, if it's more of an annuity, I hate to say structured for
A standard long.
but it's
okay.
an annuity that has a strong long-term care component.
Right.
Sometimes you're going to have
More
limited,
underwriting.
limited
Right.
underwriting.
Right.
Okay.
But compared to maybe a standard long-term care policy, way less underwriting and much more easy to qualify for it. And one thing that I would like to point out here, and Eric, that you and I have ran into quite a bit, and that is the cost of long-term care. Well, first of all, just the cost of long-term care now. I mean, you're looking at most places that you go, somewhere around 6,000, 7,000 per month, maybe 5,000 on the low end, and again, depending on the degree of care you need. So this has caused the cost of long-term care insurance to keep escalating as these healthcare costs go up. And then there's another factor that there's less people actually opting to buy long-term care than what was predicted statistically.
Right.
So folks are living longer, they're in long-term care longer,
Right.
the expenses are more, and so what's really happened that we've seen is that these long-term care policies that someone purchases when they're, say, 45 years old because they're trying to be responsible,
Right.
they've paid these premiums for 20 years, and what wasn't supposed to go up much is now going up dramatically.
Well, and we have clients in this type of situation where
Yeah.
they did the right thing. They were 40s, purchased care. They're now 10 years into it, and the premiums have escalated significantly.
Right.
To the point where now they're questioning whether or not they could continue to afford them, to the point where they needed the insurance.
Right, right. So they're faced with, do I get rid of my long-term care policy because of the expense, and knowing that by the time I really need it in the next 15 or 20
Right.
years, at the rate it's going up, will I even, do I want to keep paying these premiums as a exercise of futility?
Yeah.
So what we really see is annuities moving more and more, and life insurance, moving more and more into this realm of taking care of a long-term care need, and we look at it more as an asset-based type of long-term care.
Yeah, insurance companies have done an excellent job of kind of adding these living benefits into more and more of their products.
Right.
We're seeing it, as you just said, life insurance being used for long-term care actually now as well.
Yes,
So,
yes. We should also mention the tax-free benefit
yes.
of life insurance. That it really, if it's structured properly, I said life insurance, but annuities and life insurance. It just depends on how it's structured, but it's a great benefit to be able to pull out long-term care money and have that all be tax-free.
Right, and with annuities we have to be careful because it depends on the policy itself.
Yes, it does.
Now with life insurance, if you're using that,
Pretty standard.
it's pretty standard.
It's
That will
tax-free.
come out tax-free.
Yes.
Because you're technically actually withdrawing the death
The death benefit early.
which is a tax-free
Right.
distribution. So.
Right. So I think in summary, everybody's situation is unique and individual, and you hate to just tell somebody, hey, cancel that long-term care policy because you might need it and you might want to keep it. But I have had several clients that have canceled their long-term care policy, maybe didn't intend to initially, but as it kept going up and they had other ways to cover their long-term care and supplement it, it worked out well. So.
And that was just exactly it. They redirected their
Right,
dollars
right.
from a policy that they were concerned they weren't going to be able to pay for into a vehicle that they knew
Right.
they were going to have predictability and reliability.
And one thing that we've avoided, and that I
We're no
should
longer
say,
summarizing.
we've avoided the word hybrid annuity. But hybrid annuity is really where this is happening at. I mean, the hybrid annuity has brought this long-term care benefit in, and so that's another aspect of the hybrid annuity.
So in summary, if we're going to tell you, if you're looking for an annuity with a long-term care portion piece included in it,
Right.
check out some of the hybrid annuities,
Correct.
because a lot of times you're going to find a piece or some feature or rider that's available to you on those particular products
Right.
that's going to have a long-term care
Yeah,
component.
that's true. Absolutely.
Very good. So
Thank you.
check them out. Have a great weekend.